Imagine waking up each morning, feeling the weight of another month's financial struggles pressing down on you. You glance at your bank account only to see your hard-earned Naira slipping away to bills, debts, and endless daily expenses. The dreams of owning a home, sending your children to school, or enjoying a worry-free retirement seem distant, almost unreachable. Now, picture a different reality. Your money quietly growing in the background, multiplying without the constant stress and uncertainty. Instead of watching your earnings disappear, you see them thrive, building a secure future for you and your loved ones. The top 1% in Nigeria aren't just lucky. They're leveraging smart investment strategies like mutual funds to blow up their wealth. What if you could join them, transforming your financial chaos into clarity and confidence, turning every Naira you earn into a stepping stone towards prosperity? Stay with me and let's explore how mutual funds can be the key to unlocking the financial freedom you've been striving for. Welcome to our guide on mutual funds. Mutual funds are a strong financial tool made to make investing simple for everyday people like you and me. They provide professional management, spread your investments, and give you peace of mind. Whether you are just starting or want to improve your investment plan, mutual funds are an easy and effective way to build a safe financial future. A mutual fund is like a big pot where many people put their money together to invest in different things, such as shares of companies, bonds, or other assets. Instead of buying these investments by yourself, a professional manager handles the money for everyone in the pot. This way, even if you don't have a lot of money, you can still invest in many different companies and spread your risk. Let's say you invest in the Stanbic I.B.T.C. Nigerian equity fund. This mutual fund takes money from many investors and buys shares of top Nigerian companies like Seplat Petroleum, Guarantee Trust Bank, and others. As these companies grow and their share prices increase, the value of your investment in the mutual fund also grows. If one company doesn't do well, the good performance of other companies can help keep your investment stable. There are different types of mutual funds to suit everyone's needs. Some are aggressive and aim to grow your money quickly. Because they are aggressive, they carry high risk and can lose your money. Other mutual funds are low risk and focus on keeping your money safe. These safe funds grow slowly but are reliable. Then, there are mutual funds that mix both high risk and low risk investments. These are called medium risk funds. They balance the potential for higher returns with the safety of lower risk investments. We all have different circumstances when it comes to money. Maybe you're starting late in investing and want to grow your money aggressively to catch up. Or perhaps you prefer a slow and steady approach. Maybe you're in debt and need to balance risk carefully. Whatever your situation, there's a mutual fund that fits your needs. First, let's talk about equity-based funds. These funds mainly invest in stocks or shares of companies. The goal is to grow your money by investing in companies that are expected to do well over time. Imagine you have a basket where you collect pieces from different companies, like owning small parts of your favorite brands. An equity-based fund works the same way. Many people pool their money together to to buy shares in various companies, both big and small. The hope is that these companies will grow and become more valuable over time. However, it's important to understand that higher potential returns come with higher risk. Stocks can be volatile. Their prices can go up and down based on how well the company is doing, the economy, and market feelings. This means you could lose some money if the companies you invested in don't perform as expected. Despite the higher risks, equity-based funds are popular among investors who want to grow their wealth significantly over the long term. The chance for higher returns makes them attractive to those who are okay with taking more risks for the possibility of greater rewards. For example, in 2024, the ARM Aggressive Growth Fund grew by 19%, and the Meristem Equity Market Fund grew by 25%. These two funds each had over 75% of stocks in their portfolios. Imagine you invest 1 million naira and earn a 25% return each year. In 20 years, your 1 million naira would grow to 86 million naira, all without making any additional investments. These impressive growth rates show the benefits of investing in equity-based funds, helping you build substantial wealth over time. Equity-based funds are ideal for those with a long-term investment plan. They are perfect for people who want to maximize their capital growth by investing in companies with strong growth prospects. Next, let's talk about money market funds. These funds invest in short-term debt, like treasury bills, commercial papers, and certificates of deposit. The main goal is to keep your money safe and easy to access while giving you small returns. Imagine you have a bank where you keep your money safe. Sometimes, you let trusted friends borrow a little bit of it for a short time. They promise to give it back soon with a tiny bit extra as a thank you. A money market fund works the same way. It's a place where many people put their money together to lend to very trustworthy places for a short period. These places include the government, big companies, and banks. For example, when the government needs money for a short time, it issues something called treasury bills. Think of treasury bills as a promise from the government to pay back your money after a few months with a little extra. Similarly, commercial papers are promises from big companies to pay back the money they borrow, and certificates of deposit are like promises from banks to return your money after a short time with a bit of extra. The main goal of money market funds is to keep your money safe and easy to get whenever you need it. They do this by investing in these short-term promises, which are very reliable. Because they invest in these safe and short-term things, money market funds are considered low risk. This means there's very little chance you'll lose your money. They are also stable, meaning the value of your investment doesn't change much. Instead, it stays pretty much the same, giving you a small but steady return. In 2024, the United Capital Money Market Fund grew by 21%, and the ARM Money Market Fund grew by 22%. Then we have bond or fixed income funds. These funds invest in bonds issued by the government, local authorities, or big companies. The main goal is to earn regular income through interest payments while keeping your original money safe. When you buy a bond, you are lending money to the issuer, like the government or a big company. You might think this is the same as a money market fund, but the main difference is time. Money market funds lend your money for short periods, like 30 days or 90 days. Bond funds lend your money for longer periods, 12 months or more. The main goal of bond or fixed income funds is to earn regular income from interest payments while keeping your original money safe. Since these funds invest in bonds, which are generally safer than stocks, they are considered low-risk investments. This means there is a smaller chance you will lose your money compared to equity-based funds. In 2024, the SFS Fixed Income Fund grew by 19%, and the Marble Halal Fixed Income Fund grew by 11%. Next, we have balanced funds. These funds invest in both stocks and bonds. The goal is to balance growth and income while reducing risk through diversification. The United Capital Balance Fund is an example. Balanced funds are ideal for investors who want a mix of growth and income with moderate risk. A balanced fund combines the best of both worlds: stocks for growth and bonds for income and stability. They aim to achieve higher returns than bond funds alone by investing in stocks. At the same time, they offer more stability than equity-based funds by including bonds. This makes balanced funds perfect for people who want moderate risk, not too risky, but still offering the potential for growth. For example, the ARM Discovery Balance Fund grew by 22% in 2024. This shows how a balanced approach can effectively grow your money while keeping it relatively safe. These funds are great for investors who want a mix of growth and income, providing a well-rounded investment option that can adapt to different market conditions. Next, we have specialized funds. These funds focus on specific sectors like energy, infrastructure, or commodities. A specialized fund concentrates your investment in particular areas that are expected to grow a lot. For example, the Marble Halal Commodities Fund targets sectors that can offer big returns if those industries do well. However, because these funds focus on specific sectors, they come with higher risks. Imagine if cotton suddenly loses popularity, you might lose some of your investment. Despite the higher risks, specialized funds like the Marble Halal Commodities Fund can be a great choice for investors who understand the specific sectors they are investing in and are okay with the risks. The Marble Halal Commodities Fund grew by 30% in 2024. Now, let's talk about another type of mutual fund called dollar funds. These funds are special because they invest in bonds that are denominated in dollars instead of the local currency, Naira. Think of dollar funds as a safe place to store the value of your money. Dollar funds invest in bonds issued in dollars, which are strong and stable. These bonds come from reliable places like governments or big companies. They promise to pay back the money you lend them with a little extra over time. For example, the Stanbic I.B.T.C. dollar fund is a perfect example of a dollar fund. This fund grew by 7% in 2024, showing how it helps store and grow the value of your money in a stable way. By investing in bonds denominated in dollars, dollar funds protect your money from changes in the local economy and inflation. This makes them an excellent choice for people who want to keep their money safe and ensure it maintains its value over time. Next, we have exchange-traded funds, or ETFs. These funds invest in a basket of securities that track an index, sector, commodity, or other assets. Think of ETFs as a diversified shopping basket where each item represents a different investment. This basket can include stocks, bonds, or commodities, allowing your money to spread across various assets without you having to pick each one individually. ETFs provide diversified exposure to specific markets or sectors and are traded on stock exchanges just like individual stocks. For example, the new gold ETF lets you invest in gold without needing to buy and store the physical metal. The Stanbic I.B.T.C ETF 30 fund allows you to invest in a diverse portfolio of 30 top-performing companies. These examples show how ETFs offer flexibility and diversification benefits, making it easier for you to manage your investments. Additionally, ETFs often come with lower fees compared to traditional mutual funds, making them a cost-effective option for investors. However, the risk levels of ETFs vary based on the assets they track. For instance, a gold ETF might be affected by changes in gold prices, while an ETF tracking the top 30 companies could be impacted by how those businesses and the overall market perform. ETFs are a great choice for investors seeking diversified exposure to specific markets or sectors with the added benefit of trading flexibility. They are ideal for those who want to tailor their investment portfolio to match their financial goals and risk tolerance without the complexity of managing multiple individual investments. Are you ready to start investing in mutual funds? Let's walk through the steps you need to take to get started here in Nigeria. First, choose a trustworthy mutual fund company. Some of the well-known names include Stanbic I.B.T.C, Afrinvest, ARM, Cowrywise, and F.B.N. Quest. It's important to select a company with a good history, positive reviews, and reliable customer service. Look for companies that offer different types of funds to match your investment goals and how much risk you're comfortable with. Once you've chosen a fund company, the next step is to open an investment account. You can usually do this online through the company's website or mobile app, or by visiting their local office. You'll need some basic documents like your bank verification number, a valid ID like a driver's license or passport, and a bank account to handle transactions. After setting up your account, it's time to choose your mutual fund. Research is important here. Look into each fund's goals, past performance, fees, and the experience of the fund manager. With your fund selected, you can start investing your money. Decide how much you want to invest, keeping in mind that some funds have minimum investment amounts. Follow the company's process to transfer funds, which could be through a bank transfer, mobile banking, or other available methods. It's important to keep an eye on your investment regularly. Check your fund's performance by reviewing statements and updates from the mutual fund company. Based on how your fund is doing and your financial goals, you might decide to invest more money, withdraw some of your investment, or switch to a different fund that better fits your goals. By following these steps, you can start investing in mutual funds confidently. Choosing the right company and fund, investing the right amount, and keeping track of your investments will help you build a secure financial future. If you enjoyed this video, please give it a like and share it with your friends and family Who could benefit from learning about mutual funds? We'd love to hear your thoughts and experiences, so leave a comment below with any questions or stories you have about investing. Don't forget to subscribe to our channel and hit the notification bell so you never miss our latest videos. Also, make sure to check out our other videos like the top 7 ways to make 1 million naira online in Nigeria fast and the top 5 Nigerian stocks to invest in. Cheers.